Hello everyone. In today's video we are going to consider tax impact of property, plant and equipment ownership, and particularly the thing which you can write off on your taxes, on your company taxes, on your business taxes when you buy and use property, plant and equipment for your business. You will be able to deduct the cost of purchased equipment in full in the year of acquisition, or will be able to depreciate it over time. Most of today will turn around IRS publications. If you remember, I will show you where to get them. You can just Google IRS publications, and on that page IRS summarizes sorry, I'm still having a bit of a cold. So here IRS summarizes the tax code in a more readable format with some examples, and we will look at publication 946, How to Depreciate Property. And I will copy link address here and I will paste it here. If you took part in this week lectures, you will remember that we considered when we capitalize property, plant and equipment, what amounts do we capitalize for property, plant and equipment. Particularly we capitalize purchase price and we capitalize costs to bring and to install equipment in the on the operation side and bring equipment into the ready to go condition, including various form of tests. In tax basis will look pretty much the same. So let's go take a look at the tax code. Let me sorry. Okay, so I uploaded IREX tax guide with my notes to the course folder, and you can find everything else on that link. So let's go to PP&D. So the publication is called How to Depreciate the Property, and today we are going to take a look at what property can be depreciated, what cannot be depreciated, when does depreciation begin and end, what method you use to depreciate, what is the basis of your depreciable property, how do you treat repairs and improvements. All of these questions, they are mostly the same as we considered in the lecture on accounting for PP&D. I will cough from time to time. Hopefully it will get better. So we will have only minor differences, and the most major difference will be around the depreciation methods. We will also consider a significant difference with accounting, which allows us to deduct full value of PP&D, full or most of it. It's one is 179 deduction, and the other one is special depreciation allowance, including bonus depreciation. On some of the next videos or lectures, we will also consider depreciation methods, tax depreciation methods. Okay. So what property can be depreciated? This document contains quite a bit of useful information, so I recommend anyone, if you do books for a business, and the business you do books for acquires a property, plant, or equipment item, first of all, you go to accounting guidance and you do an accounting entry. And most of the time your entries will be about the same. So I did a bit of refresh for tax memo, which we were doing in earlier lectures. So when we acquire the property, we debit the property and credit the sources we use to finance our property. Debit cash, credit cash, loan, trade payable, etc. Whatever source of funding we use to PP&D. And we debit property for acquisition cost plus transportation to operating site plus expenses to bring to operating condition. And we have tax under cash basis here. Let me do it this way. Okay, so under tax, most of the time will be the same as accrual basis of accounting. Note, there is one caveat which is called safe harbor rule under certain conditions. PP&D of I believe it's 2,500 or 5,000 can be written off on acquisition. So there is a provision about safe harbor in the tax code, which allows you, if PP&D are below certain threshold, it is 2,500 if you are not audited, and 5,000 if you are audited. You can write expense in tax account in those PP&D the moment you bought them. But there are certain limitations on that. So generally, capitalization is about the same as PP&D. Let's take a further look. So what property can be depreciated? You can depreciate most type of tangible property except land. It's the same as in accounting. Building, machinery, vehicles, furniture, and equipment. To be depreciable, the property must meet all of the following requirements. You must own it. You must use it in your business or income-producing activity. It must have a determinable useful life. It must be expected to last more than 1 year. So basically, all of the same, we have the same stuff in accounting standard, and we have the same stuff in the IRS publications. So property you own it's most of the time it's straightforward. If you have a title, if you bought that property for yourself, you own it. Sometimes it can be leased property, but you can depreciate leased property only if you retain the incidence of ownership in the property. And we will have the definition of incidence of ownership. Therefore, if you do not retain incidence of ownership, and if you lease property from someone to use in your trade and business, generally you cannot depreciate its cost because you do not retain the incidence of ownership. And what is incidence of ownership? It's the legal title to the property, the legal obligation to pay for the property, the responsibility to pay maintenance and operating expense, the duty to pay any taxes on the property, the risk of loss in the property if the property is destroyed, condemned, or diminished. So basically, depending on the lease conditions, it will be either the lessee who can depreciate the property, so the one who is leasing the property, or the initial owner. So you must be accurate. If leasing property is involved, you must pay more attention to whatever is in the guidance, in the tax guidance. And if you have any questions, you can write your questions about BB&D topic or about any other topic. It is Q&A what we have today. Okay, there are pieces of guidance which I will skip, like cooperative apartments. It's some exceptional stuff, so I will scroll down. Okay, property use in your business or income producing activity. To claim depreciation on property, you must use it in your business or income producing activity. So sometimes you can, if you buy some car, even if you buy it kind of in your business name, but if you use that car for personal purposes, for like personal travel, you cannot expense. So it is prohibited by IRS guidance to expense those costs. Okay, so what cannot be depreciated? So land, the same as in accrual basis accounting, land cannot be depreciated. But also you cannot depreciate the land. You can depreciate certain land preparation costs, such as landscaping costs, incurred in preparing land for business use. These costs must be so closely associated with other depreciable property that you can determine a life for them along with the life of associated property. So though land itself is not depreciable, you can depreciate some other expenses. Okay, let me see. I hope sound is okay and picture quality is okay. If picture is not good enough, change the definition, hit the widget and put 720p. Just a second. Okay. And with the land, there are a couple more exceptions. Property placed in service and disposed in the same year. So if you buy some property and sell it in the same tax year, you cannot depreciate that property. Equipment used to build capital improvements. You must add otherwise allowable depreciation on the equipment during the period of construction to the basis of your improvements. This principle is kind of similar to what we saw in accounting guidance related to self-constructed property. So it's not a surprise, but IRS has its own rules. It's called Uniform Capitalization Rules, Publication 551. So you wanted to check it out. If you constructed some plant or equipment and you use your own equipment in doing that, you need to check out Publications 551. Section 197, Intangibles. You must amortize this cost. Section 197 intangibles are discussed in details in Chapter 8. Intangible property such as certain computer software that is not Section 197 can be depreciated. Okay, so when does depreciation begin and end? And again, this part is pretty much the same as in accounting piece. We begin to depreciate your property when we place it in service for use in your trade or business or for the production of income. So we start when we place it in service, not when we actually start to use it, but when it is ready to be used in the business. And we stop depreciation property after when we have fully recovered our cost or other basis, or when we retire item from service. So basically same approach as in accounting. You place property in service when it is ready and available for specific use, whether in business activity, an income producing activity, a tax exempt activity, or personal activity. So when it's ready to be operated, we start to depreciate it. So for example, if we bought a house to use as residential rental property, we made several repairs and had it ready for rent on July 5th, and we bought it in April. So we start to depreciate it in July, when it's ready for operation. Idle property. If property is temporarily idled, we continue to depreciate it. So if we stopped to use some machine due to lack of market demand, we continue to depreciate that machine. Or if we fully depreciate it, again, we stop to depreciate it. We cannot depreciate more than a basis of the property. Or if we disposed of the item. So we sold it, we converted to personal, we abandoned it. So that's where we stopped to depreciate it. What methods can we use to depreciate the property? So here lies the biggest difference, one of the biggest differences with accounting. We must use modified accelerated cost recovery system to depreciate most property. We use that markers in every situation with a few exceptions. So some old stuff, 1986 and 1987 stuff, intangible property, films, so like entertainment stuff, and some elections to exclude from that system. Modified accelerating cost recovery system. We will not look much into details of that system today because it requires a good investment of time. We might do that in one of the next lessons. So I will skip. So the only thing which we need to remember is that there is a special depreciation system for that, and that system it's also in that document. Let's go. Intangible. Generally, if you can depreciate intangible property, you usually use straight line method. So intangible is usually straight line. It can also have depreciation based on income. So you kind of depreciate it proportionally to your income compared to expected income. Election to exclude property from makers. if you can properly depreciate any property under a method not based on a term of years, such as a unit of production method, you can elect to exclude that property from MACRs. So for unit of production method, you can use unit of production method instead of MACRs. If you use a mileage rate for your car, you still your car is still being depreciated for tax purposes. You just do not deduct that depreciation. So your basis, the basis in your car is decreasing. So you are treated as having made an election to exclude the automobile from MACRs. So what is the basis? Basis is usually your acquisition costs. So costs as a basis. So let's make this note here. So your cost will be your basis for property, plant, and equipment. Okay. There are a few options about state sales taxes. If your property purchase involves state sales tax, you need to pick between different treatments. And if you decide to deduct state sales tax on your Schedule A, you cannot include those sales tax as part of your cost basis. Again, not only if you paid for PP&D with cash, you capitalize all the amount and you include all your payment. Also, if along with cash you assumed some debt, if you used a loan to acquire property, you still use the full cost of your property. Here is the example. If we make a $20,000 down payment on a property and assume the seller's mortgage of $220,000, our total cost is $140,000. So we do not only calculate cash, we include full basis. As well as we include settlement costs, legal and recording fees, abstract fees, survey charges, owner's title insurance, all of the stuff. All of the stuff, and the same stuff we usually capitalize for accounting purposes. If we construct or build property, again, it will look pretty similar to accounting capitalization, but IRS has its own uniform capitalization rules. So you need to pay attention to that. And that was about cost basis. So if we acquired the property and pay for it with cash or by assuming loans, we can also have some other basis. For example, if we acquire the property in exchange for other property, or as payment for services, or if we, for example, inherited that property, we can have other bases in the property. If you held property for personal use and later, so that's an interesting example. If you have your own car and you started a business and you decided to contribute that car to the business, and later use it in your business, your depreciation basis in the is the lesser of the fair market value of the property on the date of the change in use, or your original cost or other basis, other adjusted basis. If you did an improvement, you need to take those improvements into account. Or if you claimed any deductions related to casualty and theft, you need to adjust that too. And finally, adjusted basis. Increases and decreases to the basis of the property for events occurring between the time you acquire the property and the time you place it in service. These events could include the following: utility lines, paying legal fees for perfecting the title, setting zoning issues, receiving rebates, incurring a casualty or theft loss. So if you have any of those, you need to go take a look at publication 551. If you do not claim depreciation you are entitled to deduct, you must still reduce the basis of the property by the full amount of depreciation allowable. If you deduct more depreciation than you should, you must reduce your basis by any amount deducted from which you received a tax benefit, the depreciation owed. So basically, if for some reason you forgot to take depreciation, or you are taking standard home office deduction, or you're taking standard mileage rate for your car and your home office, they are still being depreciated in your tax accounting. So you have to consider whatever provides you with lower taxable income, the standard mileage or standard home office or depreciation. Repairs and improvements. Again, same treatment as with accrual basis accounting. Whatever you have in accounting for repairs and improvements, you will have the same approach in taxation. If you improve depreciable property, you must treat the improvement as separate depreciable property. So if it improves, remember in accounting a few days ago we had a conversation. So if you improve the capacity of the assets, if you improve the asset, or if you increase the useful life of the asset, you capitalize the repair. If not, you just expense it. Okay. And finally, there is a special form on your tax return, 4562, which you use if you use depreciation. If you have depreciable property, you have to use this form. Use form 4562 to figure out your depreciation, deduction, and amortization. Attach form to your tax return for the current year if you're claiming any of the following: a section 179 deduction, depreciation of a vehicle, deduction for any vehicle in the deduction is reported on a form other than Schedule C. So pretty much if you use any property in your business, you most likely will need to use that form. How do you correct depreciation deductions? If you filed your taxes incorrectly, you submit the corrected income tax, amended income tax return. Sorry. Okay, let's take a pause and go back to our accounting memo. Go back to our accounting memo, and we have a statement on depreciation here. So we depreciate based on accounting straight line production accelerated, and we have debit depreciation credit accumulated. And for the taxes, we depreciate based on Macker's depreciation method. And it's accelerated in some cases, straight line and production methods are allowed. So we use basically different methods of depreciation for accounting and for taxes. And tax methods will usually result in accelerated depreciation. So you will recognize more expenses earlier compared to your accounting. And you will pay less taxes due to that. So that's done to motivate you to invest in fixed assets, to make investments for your business. Now, section 179 deduction. Let's add a couple of lines here and put it here. Oh no, didn't. Not applicable to accounting. So in addition to depreciation, to tax depreciation, tax code gives you a couple of more options to accelerate your depreciation even more compared to accelerated depreciation method. Basically, these methods allow you to write off your some of your property in the first year, in the year when you acquired it. So let's see. You can elect to recover all. So when we say recover all, it means that we kind of depreciate all. So we write off for the tax purposes the full amount of your acquisition price, of your capitalized amount. You can elect to recover all or part of the costs of certain qualifying property up to a limit by deducting it in the year you place the property in service. This is the section 179 deduction. You can elect the section 179 deductions instead of recovering the cost by taking depreciation deductions. Okay. So we move it here to our accounting, tax accounting. Section optional. So we can use it or we can skip it. So let's see the details, when we can do that. So what property qualifies? To qualify, we need to meet the following requirements. It must be eligible property. It must be acquired for business use. It must have been acquired by purchase. It must not be property described later under what property does not qualify. So, eligible property, acquired for business use, acquired by purchase, not exchange property, not inherited property, only by purchase. So what is eligible property? Tangible personal property, other tangible property, except buildings and their structural components, single-purpose agricultural storage facilities, except buildings used in connection with distributing petroleum off-the-shelf computer software, qualified, section 179, real property described below. So since we have tangible personal property, so we have two types of property: real property, which is like land and buildings attached to the land, and we have tangible property, which is basically almost everything else, except probably like an inventory. So inventory will be accounted differently under taxation. So tangible property is your long-term property, which is not inventory and which is not real property. Basically, all the equipment. Tangible personal property. So what's included in tangible? Machinery and equipment, attachments to the building other than structural components such as refrigerators, grocery store counters, office equipment, gasoline storage tanks, livestock, portable air conditioners or heaters placed in service by you in tax year beginning after 2015. And else, computer software, some real property which qualifies, and it's mostly like some improvements and improvements to non-residential real property like roofs, heating, fire protection, security systems. Okay. Doesn't include, so qualified doesn't include enlargement of the building, elevator or escalator, internal structural framework of the building. So acquired for business use, I believe that should be clear. Partial business use. When you use property for both business and non-business purposes, you can elect the section 179 deduction only if you use the property more than 50% for business in the year you place it in service. If you use the property more than 50% for business, multiply the cost of the property by the percentage of business use. Use the resulting business cost to figure out your. So if you own a car and you use it for personal purposes, and you also use it for business, to claim that section 179 to write off all or part of the cost of certain qualifying properties. So we can write off, if you use the car for business for 60% of the time, you can claim that section and write off 60% of your car. And that's what same is in the same example. We bought and placed in service an item of 179 property costing 11,000. We used the property 80% for her business and 20% for personal purposes. The business part of the cost of the property is 8,800. So that can be written off with section 179. And also we might purchase the property. Property is not considered acquired by purchase. It is acquired by one component member of a controlled group. So basically, if you move property around the companies which you control or which are consolidated in the same tax return, it will not qualify for 179. If its basis is determined either in whole or in part but by its adjusted basis in the hands of the person from whom it was acquired, or under stepped-up basis rules for property acquired from a descendant. So basically, if you got it not by purchase, or if you bought it from related person, so that won't qualify. So if you bought a car from your wife or from your husband for your business, that won't qualify. And here is an example that a tailor bought 2 industrial sewing machines from his father. They do not qualify for 179 because Ken and his father are related parties. Again, land and improvements to the land do not qualify. And exceptions, Other exceptions for the property, it can be leased property, property used predominantly outside the United States, property used by certain tax-exempt organizations, property used by government units or foreign persons or entities. If you have leased property, you need to pay more attention to these regulations. If leasing is involved, you need to read it more carefully. Your cost 179 deduction is generally the cost of the qualifying property. However, the total amount you can elect to deduct under Section 179 is subject to a dollar limit and a business income limit. So that's about how much you can deduct. So generally it's the cost, the full cost of your property, but there are limits involved. The first one, if you did a trade-in, you will only calculate your cash price. So you paid cash and you traded in your old car or whatever piece of equipment. You can only take into account your cash consideration. Next, there are limitations on the amount which you can deduct under this section. And the total deduction under this section cannot be more than $1,040,000. And that $1,040,000 can fluctuate. It can fluctuate depending on your total amount of acquisitions during the year. Under certain circumstances, the general dollar limits on the Section 179 deduction may be reduced or increased, or there may be additional dollar limits. The general dollar limits is affected by any of the following situations. The cost of your Section 179 property placed in service exceeds $2.5 million. Your business is an enterprise zone business. You placed in service a sport utility or certain other vehicles. You are married, filing a joint or separate return. So generally your maximum deduction is $1,040,000, but there are limitations and most of them just decrease the amount. If the cost of your qualifying Section 179 property placed in service in a year is more than $2.5 million, you must generally reduce the dollar limit, but not below zero, by the amount of cost over 2.5 limit. If the cost of your Section 179 property placed in service during 2020 is $3.6 million or more, you cannot take a Section 179 deduction. So that is taken to give that deduction only to small businesses. So if you are acquiring less than 2.5 million of property in a year, then you can use that deduction. Let's do a couple of updates here. Okay, your property must qualify. Most tangible property qualify. You take 100% of cost deduction, but there are exceptions not includable in cost, like trade-ins. You must purchase and use in business less than 50% personal use. You can deduct up to approximately $1 million. if your section 179 acquisitions in a year are less than 2.5 million and deduction decreases to 0 if you acquired more than 3.6 million. Okay, so it's a good deduction for small business, but if you are not small business, if you're big business, that's generally not reachable for you. You cannot do that. And several more details. We will not stop there long enough. There is issues if you are married. You generally have one deduction. You and your spouse will be treated as a one taxpayer if you file in jointly, and if you file in separately, it will be just one deduction for you both too. Business income limit. So you cannot deduct the total cost you can deduct each year after you apply the dollar limit is limited to the taxable income from the active conduct of any trade or business during the year. Generally, you are considered to actively conduct a trade or business if you are meaningfully participate in the management of operations of the trade or business. So you cannot deduct more than your earnings. Any cost non-deductible in 1 year under Section 179 because of this limit can be carried to the next year. Special rules apply to deduction of qualified Section 179 real property that is placed in service by you in tax year beginning before 2016. So if your if your taxable income is pretty small and 179 deductions covers more than you have taxable income, you will carry that forward to the next tax year, but you need to pay special attention to the guidance in that situation. So what do we have here? There are other deductions which depend on your available taxable income. So for example, if some corporation purchase and place in service qualifying Section 179 property with a cost of 1,040,000, so that's the maximum deduction. It elects to expend the entire 1,040,000 costs under Section 179. In June, the corporation gave a charitable contribution of 10,000. The corporation's limit on charitable contributions is figured after subtracting any Section 179 deduction. The business income limit for the Section 179 deduction is figured after subtracting any allowable charitable contributions. So, taxable income figured without the Section 179 deduction or deduction for charitable contribution is 1,060,000. So taxable income before the deduction 160. Using 160 as a taxable income, XYZ's hypothetical Section 179 deduction is 140. 20,000. So whatever is left after the deduction, and our charitable contribution is limited to 10% of taxable income, so it will be 2,000. Step 5, 158. That's the income for Section 179 deduction. And because of that, we can take full amount. So we will, in this situation, we can take full deduction for 179 and only 2,000 for charity. We can carry over the unlimited number of years the cost of any qualified Section 179 deduction. Okay, so we have some guidance for partnerships, for S corporations. How do we elect a deduction? We can elect the deduction by completing Part I, Part 1 of Form 4562 on our original 2020 return or amended return. Sorry. Okay, I'm back. In addition to 179 deduction, we have special depreciation allowance, and we actually have several such allowances. We can take special depreciation allowances to recover part of the cost of qualified property placed in service during the tax year. The allowance applies only for the first year you place the property in service. The allowance is an additional deduction you can take after any or Section 179 deductions. So let's special depreciation allowance. Capitalization. So let's say first okay, second special depreciation allowance, and it's also not applicable in accounting, so it's purely tax item. Let's move it here. Special depreciation allowance. So we have some qualified property. So when can we take special depreciation allowance? Your property is qualified if it is one of the following: reuse and recycling property, qualified second generation biofuel plant property, certain qualified property acquired before September 2017, certain qualified property acquired after September 2017. So let's add it here. And let's see what property is included. So reuse and recycling. So this is one-off items. We do not look much into it. Reuse and recycling. Biofuel plant property. So you just need to know that it's there. If you have to deal with reuse and recycling or biofuel plant and property, you go straight to that guidance. Certain property with a long production period and certain aircraft acquired before September 2017. Long production period property. So let's just add it here. So it must be placed in service before January. What? Okay, must be placed in service before January 1, 2021. The original use of the property must begin with you. So it should be like a new property, not used. It is not accepted property. To be qualified, long production period property must meet the following requirements. So 1.3, so this 1.3. The property has a recovery period of at least 10 years or is transportation property. Transportation property is tangible personal property used in the trade or business of transporting persons or property. The property is subject to Section 263 of Internal Revenue Code. The property has an estimated production period exceeding 1 year, and an estimated production cost exceeding 1 million. You must have acquired the property or acquired the property pursuant to a written contract entered into before January 1, 2020. So basically stuff like aircrafts or some property with a useful life of at least 10 years. It can qualify for that depreciation allowance. And the last one is qualified property acquired after September 2017. You can take 100% special depreciation allowance for property acquired after September. So that was what is known as Trump tax reform. So basically, we can take 100% special depreciation allowance for property acquired after September 27, 2017 and placed in service before January 1, 2023. Your property is qualified property if it meets the following. Tangible property depreciated under markers with a recovery period of 20 years or less. Let me see what we already copied here. Let me how to. Okay, probably cannot make it shorter. It's so we just need to remember that we are only copying key points here. Okay, the editing here is awful. Doesn't work quite good. Okay, does it say how much? So this one, the old stuff, is 30% special depreciation allowance, just 30%. But what is under Trump tax reform? It's 100% bonus depreciation. How to copy that? Okay. So we can take 100% bonus depreciation, and the main requirement is it's basically every tangible property with a recovery period of 20 years or less. So, for example, if you buy a building, it's usually more than 20 years, especially if it's like residential building. But if we replace a heat pump in the building or refrigerator or something else, we can generally take, based on that provision, we can write off the full cost of such improvement in the year when we acquired it. So it's very beneficial if we want to accelerate our tax expenses and decrease our current tax income. But our future tax income will be more, and we need to know for sure what we are doing. Okay, let's see. How can you elect not to claim an allowance? You can elect for any class of property not to deduct any special depreciation allowance for all property in such class placed in service during the tax year. To make an election, extend a statement to your return indicating that your election are making and the class of property for which you are making the election. The election must be made separately by each person owning qualified property. And here is the makers, which we will do probably in the next lectures. So let's summarize. Let's summarize our experience today. So what did we learn? So for tax purposes, similar with accounting purposes, we need to figure out the taxable base of the property. And taxable base will be close to property capitalized under accounting standards. It will be match most of the time. But if you have more than complex situations when you have state taxes involved, you need to pay closer attention to the guidance. So we capitalize almost the same numbers. Then we start to get some differences. Under tax, if we are a small business, relatively small, if we acquired less than 2.5 million in property, we can take 179 deduction and deduct for tax purposes full acquisition costs of the property. But that's in case if in a taxable year we acquired less than 2.5 million of tangible property, of section 179 property. So that deduction is available to us under any circumstances, and it's optional. We can use it or we can skip it. Then we have some special depreciation allowances. And there are some available for recycling property and reuse, some biofuel property, and some qualified property acquired before September 17 and after September 17. So if it's before September 17, it's only allows 30% to deduct 30% immediately and amortize the rest. And if it's acquired after September 17, but before 2023, so that's under Trump tax reform. So if you acquired that under Trump tax reform, you can take 100% special depreciation allowance. But that will expire in a few years. So when it expires, you will be able only to take that one or this one. Or if you're a small business, you also can take this one. So first, if you want to maximize your tax deductions in current year, you can take that allowance. If you are like a relatively small business, then you can go take special depreciation allowance. And whatever is left after allowances, you depreciate it based on macros. So in accounting, you have one type of depreciation available to you. Not one type, few types of accounting depreciation: straight line, accelerated, production method. In taxes, you will use macros most of the time, but also you will be able to use production method in certain situations, or a straight line method for stuff like intangibles. So that's pretty much old tax and accounting differences. Here is the link to the file where I updated the tax memo. Thanks everyone for coming for today. We had several people watching this for some time. Thank you everyone. Tomorrow I hope we will have some sign-ups for Russian language session, and our next session on PP&D will probably happen somewhere next week. I will be away for the weekend. Thanks again, and bye bye.